the number that Buffett trusts more than any printed 10K. The figure the company prints is not the figure Buffett trusts. His version he writes in the page's margin, and it runs smaller. It is the number Wall Street never prints on a glossy cover. Firms post record profits on the page, then go bankrupt by winter. Their profit looked solid in the ledger, yet the firm went broke. By the end, you will compute Buffett's number on any company yourself. The 1986 letter that finally named Buffett's private owner earnings. He called it owner earnings, and it changed how I read a page. The cash that survives every bill is the only real profit. It is not the accountant's profit, but the money that survives onto the page. Reported profit gets dressed up. Buffett's number resists the costume. Here is the trouble hiding in the earnings line atop the page. The profit that accountants book before a dollar reaches the bank. A credit sale counts as profit the day it hits the ledger, though the buyer may default. A single warehouse sale can inflate the top line on the page, the windfall that owner earnings strips, because it never returns again. Depreciation is only Graham's estimate of where, not a real check. So the profit figure mixes real gold with fiction that has ruined investors. Feel the unease of trusting a page figure that vanished when the firm went broke. Buffett's fix is 3 pieces you will find on any cash flow page. Start with reported net income, the profit on the bottom line of the page. Add back depreciation and amortization, the non-cash charges struck out in red. Amortization writes goodwill and patents down on the page the same way. Those charges never left the building, so Buffett hands them back first. The cash that a plant secretly burns before it quietly closes. Buffett calls that last piece maintenance capital, and it is easy to miss. Net income plus non-cash charges minus the maintenance capital you circle on the page. The term that wiped out careless owners is maintenance capital itself. Maintenance capital is the cash you burn each year just to hold your place on the chart, not to grow, only to replace what wears out before the plant goes broke. Every machine ages and every roof leaks, and neglect drives a firm broke on the ledger. Ignore that cash and your owner earnings become a comfortable lie on the page. A brick oven that cost $8,000 to rebuild every 7 years, that rebuild is maintenance, pure and simple, and Graham would count it. A second oven for a new shop, though, is growth you must set aside. The mistake that wiped out owners was confusing growth with upkeep. Here is where the famous E by T day trap swallows careless investors whole. E by T day adds every non-cash charge back and stops, and the chart looks bright. It pretends the machines never need replacing, which has ruined many owners. The investors that E by T day fooled lost almost everything they once owned, or worse, they have fooled themselves and it cost them everything. A cable company once dazzled Wall Street with soaring EBIT day on every chart. The cash that rotted inside the wires quietly buried that company. The reported story rose in bright ink while the real owner earnings collapsed. The call that finally arrived wiped out every trusting shareholder overnight. Shareholders who trusted the headline were wiped out and never recovered. Feel your stomach drop the way theirs did on the day of the margin call. That kind of bankrupt ruin is exactly what Buffett's number is built to prevent. So how do you find maintenance capital when no page labels it plainly? You have 3 practical ways, and Graham would use all 3. First, read what management itself discloses about upkeep on the page. Good managers split growth projects from replacement in plain, readable words. Second, use depreciation as a rough stand-in for what wears out. The spending that finally matches 10 years of steady depreciation. If spending towers above depreciation on the chart, the firm may be going broke. Third, average capital spending across a full cycle, 5 to 10 years. The single year that secretly distorts a 5-year capex snapshot. So watch 10 years of the chart before you trust the figure. For a factory, tie replacement to the units it must keep making, split total spending into keeping and growing, and keep only the first. Growth capital buys new stores. Maintenance re-shingles the roof over the old one. Only the keeping half belongs inside Buffett's owner earnings math. Let us walk one real company the way Buffett walked his in 1986. That year, Berkshire bought a quiet firm called Scott Fetzer. Scott Fetzer made Kirby vacuums and the World Book encyclopedias. Steady, unglamorous, exactly the business Buffett loves on the page. Buffett printed this exact calculation in the letters appendix for you. He wanted shareholders to do the sums, not take his word. Open the statement and find reported net income near the bottom line. A profit that finally reached 40 million looked deceptively honest. Now add its non-cash charges, the depreciation of the plant. Say depreciation runs another 8 million across the year. Together that suggests 48 million of cash before any reinvestment. But the presses that stamp those Kirby vacuums wear out every year. Say replacing them costs 8.5 million to hold the line. The charge that Buffett subtracts is $8.5 million every single year. Owner earnings land near $39.5 million, and Buffett stops there. The gap that quietly formed below reported 40 million shocked owners. That $500,000 gap is the truth the page politely hid from you. Now you value the business on $39.5 million, not on $40 million. Walk each line, and Buffett's honest figure appears in minutes on the page. Feel how solid the ground gets when the figure on the page cannot lie. Here is why this one habit separates owners from gamblers who go broke. A gambler pays for reported earnings, the dressed-up cover story that leaves him wiped out. An owner pays for the cash Buffett's number says he can actually keep. Two firms can report the same $40 million, differ wildly underneath. One keeps almost all of it, the other feeds it back and goes broke. Buffett's favorite businesses keep nearly every dollar they earn on the page. A confectioner like C's barely needs new equipment to keep selling, so C's owner earnings sit almost on top of its reported profit. The profit that vanished into hangars quietly ruined its trusting owners. Its owner earnings vanish into hangars and overhaul, and shareholders lost everything. Same headline profit. One owner goes home rich, the other goes broke. A textile mill can report profit for a decade and still go broke. Every dollar returns to newer looms just to hold the same ground. A textile mill that nearly destroyed Buffett kept quietly eating cash. A cheap price cannot rescue a business that eats its own cash and goes broke. This is the test Buffett runs on the page before he asks a price. Keep the earnings or feed the machine until the vault runs dry. A minute of this math has saved fortunes from businesses that later collapsed. Now turn Buffett's number on a company you actually own or want. Find net income near the bottom of the income statement page. Find depreciation and amortization on the cash flow page just above. Then hunt the capital spending line in that same cash flow page. Read the footnotes on the page to split spending into grow and keep. When management stays silent, lean on depreciation as your estimate. Be conservative and guess the maintenance figure a little too high. That margin of safety keeps one bad guess from leaving you flat broke. Now you hold owner earnings, the real cash the business yields you. Divide the company's price by that figure for an honest multiple on the page. Two companies at 10 times profit can be worlds apart in real value. The cheap stock that secretly became a trap wiped out thousands, and a dear-looking one can turn out to be Buffett's gift. Price them on owner earnings and the true bargain steps into the light. That reversal is why Buffett measures cash instead of accounting ink. Feel the quiet confidence of pricing a business by what it pays you. Reported earnings answer to accountants and to quarterly theatre on the page. Owner earnings answer only to the bank balance, which cannot pretend. Depreciation can be stretched to flatter a weak year and hide a coming crash. Maintenance spending is a stubborn fact the plant floor demands or dies. So Buffett's honest number keeps an owner tethered to hard reality. Watch for firms whose spending forever outruns depreciation on the chart. They are quietly pouring cash into a bucket with no bottom and drowning. Their reported profits are a story the cash never confirms before the default. Many such firms borrow to pay a dividend they cannot fund, then default. The retailer that quietly folded reported 8 straight profitable years first. Its cash had drained into remodels the accountants on the page called routine. Owner earnings had been negative the whole comfortable time, and it collapsed. Feel the cold of learning the profit on the page was never really yours. That slow bankrupt slide is what Buffett's number warns you about years early. Now the opposite, the businesses this number quietly rewards on the page. A trademark, a recipe, a habit customers keep coming back to the door for. A toll bridge collects coins and asks almost nothing back each year. These need little capital, so owner earnings nearly equal the reported figure. Buffett will pay a rich price for that kind of machine on the page, because almost every reported dollar becomes a dollar you can actually spend. That is the compounding engine hiding inside a boring, unbroken business. You will not see it on the cover, you compute it in the margin. The number that Buffett runs on 3 companies lifts the fog. You will start seeing which profits are real gold and which are theatre. The market prices the loud headline, you will price the quiet truth. The gap between those two is where patient money is made, not lost in a crash. This one figure will change every report you open from tonight onward. You now read the page like an owner, not a spectator in the stands. Owner earnings is not a formula to memorize on a card and forget. It is a habit that keeps you honest when a hot stock is about to crash. The excitement lives in the headline, the safety lives in the cash. Buffett threw out the reported number in red, and now so can you. Compute the honest one in the margin of every page you read. If this was useful, the next lesson goes one layer deeper into the page. Subscribe and value a business the way Buffett and its owner would. Tomorrow, the interview trick Phil Fisher used to know a company better than its own CEO.